Hey fam, welcome to another episode of Good, Bad, and Ugly about real estate. I got a great guest for you today, a good friend of mine named Ian. How's it going, Ian?
I'm doing excellent, Jose. How are you?
I'm doing great, man. We've been trying to get this done for a while, so I'm finally glad that we get the chance to do this.
Absolutely. Likewise.
So we always start off the episode with me asking the guest to kind of introduce themselves. So can you introduce yourself? Let everybody know, how you got to where you are today, your journey in the real estate realm.
Yeah, absolutely. Appreciate you asking. So yeah, I mean, I've always been in the financial services realm and industry for a while. So went to school, studied finance, got my bachelor's, graduated about a little over 10 years ago. Went and got my MBA after that. The company I was working with at the time, it's a Fortune 100 company. They offered to pay for my MBA. So I said, yep, why not? I mean, I might as well get it if it's being paid for.
Right.
So went and leveled up on my education, of course. It's never a bad idea to do that. And so in the midst of all of that, I was offered to go overseas with the company and work as a contractor in the Middle East for a year. I had no ties besides, my parents and my brother in the US. And I was like, hey, this is what I'm going to do. I'll see you guys in a year. And that was in 2019. Went out there pre-COVID. When I came back, Jose, it was post-COVID. So the world was kind of flipped upside down. And experiencing the transition into COVID overseas was obviously a lot different because every country handled it entirely differently. When I came back to the US, I was like, what is all this? And everyone was working from home. My company was like, hey, we really don't have any positions for you available, in the office and where you in a finance role. Do you want to try, engineering? And I was like, sure, I guess. I don't have an engineering background, but here I am working remotely, working in a hybrid position, mainly from home. And it just gave me an opportunity to, during my off time, while I was off the clock on that job, to explore other opportunities and other side hustles, because I came back with some capital of my own. The first thing I thought about jumping into was real estate. I've always heard real estate is a great investment opportunity. It's great for taxes. It's great for building true, long-lasting and generational wealth. And so I decided to jump right into it. At the time, I don't know if you recall, Jose, but Airbnbs back in 2020, 2021, everybody was getting an Airbnb. It was like a whole craze, right? It's like everybody and their mother. Yeah, everybody and their mother was buying an Airbnb, and it was like it's almost like they were giving them out for free because everyone you met was like, I got 5, I got 10, I'm doing Airbnb arbitrage, all this crazy stuff. So before the market really got saturated with everybody owning an Airbnb, I had a business partner at the time, and we actually scaled up to 13 properties in 22 months. They were all short-term rentals. Needless to say, this was one of the most expensive learning lessons of my life because we didn't have property managers. We didn't have, and these were all Airbnbs in the Orlando, Florida area, which Disney, and we were just way in over our heads. It was great when it was great. And when it was bad, it was bad. So we lost quite a bit of money. We had to kind of, restructure a portfolio, and he wasn't living in Florida. I was living in Florida. So unfortunately, a lot of the burden fell on me to go and make trips out to the properties and try and take care of this issue and that issue. And it was like, honestly, each property is like managing its own, it's like its own business. So it was way too much, Jose. But again, I'm very grateful to have gone through that because it taught me a lot about, one, who to get in business with, and two, to be careful with who you get in business with, and two, just what to look out for when choosing an investment opportunity, and honestly properly doing due diligence and not just jumping into something because everybody else is jumping into it. You got to figure out what's right for you with your time, your resources, etc., and what makes the most sense in terms of where you're trying to be. So I thought I was going to be some Airbnb king, have hundreds and hundreds of units, and I was going to make millions of dollars in profit per month and just live on that. That's what I thought I was going to do. Scaled back down to 5 properties. After that, 5 that I kept. Now they are all long-term rentals. I'm not dealing with any short-term rentals. Whoever has short-term rentals, if it's working for you, hats off to you. But for
Right.
me, it doesn't really fit in with what I'm trying to do. I don't have the time, energy, or resources or desire to manage them or manage property managers. Because as you know, right, when you have a property manager, you're sort of managing the manager, and that takes time as well. So that's kind of my taste of how what I've done in real estate from the start to where I'm at now. Again, 5 single family rentals. I haven't dove into multifamily at this point. I've been in LP and GP deals with multifamily syndications. That's been interesting. But me personally, I've never owned multifamily. I think it's awesome if you're trying to really scale. But I have single families. It's good. It's great. My tenants are all amazing. They don't really bother me ever.
Lucky you.
And yeah, exactly. And so I can't ask for a better situation, knock on wood, at this point. And yeah, that's where I'm at in terms of real estate. I have some other businesses. I'm very, very, very passionate about tax and financial strategy, specifically related to real estate investors, because in a nutshell, Jose, right? I won't get into the nitty gritty at this point, but a lot of people, they buy properties, they sell properties, they buy, they sell, they buy, they sell, they cash flow, etc. They flip, they wholesale. There's so many different avenues to make money in real estate, as you know, and most people who are listening know. But one of the things that real estate investors, I feel like, struggle with across the board is when a property is being sold or when there's a massive amount of profit that's going to be made, we have a lovely thing called capital gains tax. Okay.
Right.
Capital gains tax can be either deferred using like a 1031 strategy or mitigated and eliminated completely using other strategies. I don't like to defer and kick the can down the road because that only creates a larger problem later on.
Right.
I like to mitigate and permanently eliminate taxes so that all of the assets, aka all of the real estate, is growing and earning and continuing to appreciate in a tax-free structure versus a tax-deferred structure. It's kind of like having a traditional IRA versus a Roth IRA. Traditional, you're not paying taxes now, right? Usually it's pre-tax money going in. You're going to owe a tax bill later when you start taking distributions. With a Roth, you're putting post-tax money in, so the money is growing tax-free. Well, would you rather pay taxes today on a small amount of money at a lower rate, or would you rather wait 20 years, 30 years from now and pay taxes on a lot larger amount of money, what it's growing to, and potentially at a lot higher rate? Taxes typically go up over time. They don't usually go down. So that's how I'm tied into real estate. Of course, I'm a real estate investor myself, but I have a lot of real estate investors who are clients of mine who are interested in strategy and structuring their portfolios and cash flow situations in a way where they're not going to get slaughtered in income tax and they're not going to have to pay a large capital gains tax bill either.
Awesome. So just quick, you went from 13 to 5.
Yep.
And the market, I would say, is what helped you pivot that way.
Yes.
And then it looks like you pivoted from being an engineer to a strategist now. So if somebody's watching this and they're like, okay, awesome. How can I benefit from knowing Ian? What can Ian do for me? I have one property and I'm cash flowing maybe, let's say, $500 a month on a property. How can Ian help me take that $500 a month and multiply it so that, I'm creating what everybody keeps saying they want to do, which is that generational wealth?
Absolutely. Yeah. Great question, Jose. I appreciate you asking that. So a couple of things. When I have a conversation with someone who owns one property or 1,000 properties, my first question usually is, because I'm in the tax strategy world, is, are you happy with the amount of money you pay in taxes? Typically, if people are making decent money and have assets that are generating cash flow, they will answer no. Absolutely not. Some of them use vulgar language, but the point is, it's right. It's like, no, I mean, who wants to pay more in taxes than what they feel is fair. And look, we're all, citizens of this beautiful country, and we have a lot of opportunity here. But I think paying a fair share of taxes is one thing, but having to pay 30, 40, 50% plus in terms of your effective tax rate, I don't think that's very fair whatsoever. And what most people don't understand, Jose, is the tax code is 70, 80,000 pages. It's actually written in order, in a manner that helps you prevent owing 30, 40, 50% in taxes. It doesn't talk about what you can't do. It talks about what you can do to mitigate your taxes. Only maybe 5% of the tax code talks about you can't do this and you can't do that. Most of the code, which most people, a regular person doesn't, besides a tax attorney or a CPA, we don't take the time to go read the tax code. Nobody does that. And I don't have a desire to do it. And I'm sure you don't either. But the point is, you need to work with experts who understand the code and can leverage it at a level where you're not paying 30, 40, 50% in tax. And so for someone that's making $500 a month, as an example, I would really ask them, hey, first off, do you have income coming in from other places? Do you have a W-2 job? Are you a business owner? Is this your business? I mean, I don't think anybody can really live on $500 a month. So more likely than not, they probably have income coming in from somewhere else. And so depending on what that situation looks like, Jose, I would have a conversation with them on a level of, hey, you have X amount of income coming into your household, right? This is generating this amount. Maybe you have other dividends and things generating interest elsewhere. How can we look at your situation from a top level, a 30,000 foot view, and structure your income and your assets, including the piece of real estate you mentioned, in a manner that's as close to tax-free as possible? Okay. Because if this client, as that you mentioned, or this example, this person's making $200,000 a year and they're single, well, they're probably in the 28 or maybe even 32% tax bracket plus, depending on what state they live in. So if they're paying, let's just call it 30%, well, out of that $500 they're generating in profit, really about 150 of it is going to the IRS. Right. So, I mean, it's really only a net of 350, which if you do the math on the ROI based on how much money they put in terms of down payment and things like that, is it really a good ROI? It could be, it could be less than 2% what they're making on their money after you do all the calculations in terms of what they owe in taxes and what they're actually taking home. So the point I'm trying to make is we need to have a good understanding of someone's overall picture, no matter how many units they own, how much real estate they own, so that we can go in and do an analysis and figure out, hey, you're making this money from your W-2, your job, right? You have these assets. This is your real estate portfolio. Maybe you own a business, maybe you don't. And then essentially work to lower their effective tax rate, lower their adjusted gross income, which real estate helps with tremendously because you can take all sorts of deductions, depreciation, things like that, and then just offset their taxes so that $500 a month cash flow is a true $500 a month. Net of taxes, because again, the goal is to get someone down into the single digit tax rate instead of paying 30 or 40 or 50%. I have clients that are in California, Jose, in New York, that are paying over 50% in tax. Over 50%. So that means if they buy a piece of real estate, and let's say they buy a piece of real estate for $500,000, all cash. I'm not saying ever do that, but in this example, and that property is generating 20% ROI, $100,000 a year profit. Okay. Well, if they're in the 50% tax bracket, that means $50,000 of that 100,000 is going to Uncle Sam. That's a little ridiculous, wouldn't you say? I mean, that's kind of crazy. You used money you already paid taxes on to go and buy and invest in real estate, and now you're paying 50% tax on that income and that interest as well. It's ridiculous. So my favorite saying in the world is, it's not about what you make, it's about what you keep.
Right.
So, we can go out there and generate $500,000, $1 million a year in revenue from real estate, from job and salaried income, W-2, business income, 1099, K-1, wherever it's coming from, doesn't really make a difference. But it's not about what you're making, it's about what you're keeping. Because if you're on a W-2, if you're sitting there and you're in the 37% tax bracket, which is the highest today, and let's say you're in Florida where there's no state tax, there's nothing. Well, on $1 million, you still have $370,000 coming out in taxes. That's a lot of money. You know what?
Yeah.
You know how much real estate you could buy with $370,000 extra dollars in your pocket every year? You could probably buy another 2 or 3 properties every single year.
That's
what
right.
kind of change? What kind of benefit would that have for your retirement plan and your portfolio? So, really, to answer your question, Jose, it's a very case by case basis. It's not about what you make, it's about what you keep. So even on a small scale, $500 a month profit, 1 unit, there are strategies we can use depending on that person's situation specific to lower their effective tax rate, lower their adjusted gross income so that they're effectively paying a lot less in taxes, which means they're keeping more of what they earn, including the real estate income. And then now they can go and reinvest that quicker back into more real estate or wherever else they choose to park it.
Awesome. So just trying to keep it at a high level because I know you'd prefer people to call you so you can kind of dig down into their particular situation.
I can't give all the secrets out.
I'll save some of those nuggets for later. How about this question? Can you share with the audience some of the vehicles you would use to help them keep more of their money? Like, for example, you hear some buzzwords like infinite banking or I don't know, solo 401ks, those type of things for self-employed. Hopefully not going too deep for you, but I know you can handle it.
Yeah, absolutely. No, I understand the question. So essentially, what you're asking is, all right, so what are some different structures that you can use in order to keep more money in your pocket, be just more tax efficient approaches to investing into specifically real estate versus making money from a job, having it sitting in a bank account, and then going and buying real estate, which is traditionally what most people do who have no knowledge on how they should actually go about purchasing the real estate.
Right.
I would 100% recommend some sort of Roth structure. If you don't know what Roth is, for those who are listening, basically Roth means post-tax, which is why your money is allowed to grow tax-free. Roth IRA, most people know what a Roth IRA is. The one issue I have with a Roth IRA is there are a lot of restrictions in terms of income. If you make too much money, you don't qualify for a Roth IRA. And there's a restriction on how much you can contribute on an annual basis. Right now, it's $7,000 annually. That depends on if you're 59 and a half or older. But the point is, you're not able to put a significant amount of money into a Roth IRA, but you can use a traditional IRA or a solo 401k, right? These are qualified accounts. To your mention, Jose, you mentioned a solo 401. Solo 401ks for business owners are extremely popular, and traditional IRAs, SIDRAs, which is basically a self-directed IRA. Those are also great vehicles because what these allow you to do is it allows you to grow your money on a tax-deferred basis, meaning you don't have to pay the taxes today, and you can go and invest in different asset classes like real estate and crypto and oil and gas and different things like that versus only putting your money in the stock market. I'm not against the stock market, so to say, but the one thing I don't like about the stock market is that we have no control over whether it moves up or down. And that's sort of in the control of everyone who's in the market, which is basically the general population and, Wall Street and BlackRock and all these big, institutions, institutional money. And so if there's a political event or an economic event, the market could easily crash 20% in a week. We've seen it happen, And so if you have $1 million working for you, Jose, boom, $200,000 is gone. There's nothing you can do. It's out of your control. I like control, and I'm not a control freak, right? That's my wife. But just kidding. I love you, babe. But she, I like more control over my money and where I'm able to invest it, how I'm able to grow it. If you put all of your assets and your savings and your money into the market, well, you're basically relinquishing all control because you just have no control over who's going to say what, which political figures are going to say what the markets, how the market's going to react, et cetera, et cetera. So using a SIDRA, self-directed IRA, a solo 401k, a Roth IRA, if you qualify for a Roth IRA, those are great vehicles. The only thing I would say to consider is when it comes to, I mentioned earlier on in the call, in the episode that, I don't like growing money on a tax deferred basis because it only creates a larger problem for you later on. Just like when people do a 1031 exchange in real estate, not only is a 1031 restrictive, you have to, like for like and buy within 45 days, and it has to fit a very specific criteria in order to qualify for the 1031 exemption. But you're only creating a larger problem for yourself later on. Sometimes a 1031 is a great strategy. Sometimes deferring taxes is a great strategy. Sometimes. But as a long-term play, we need to find a way to eliminate taxes and permanently mitigate them. There are other things like, and you hinted at it earlier, Jose, life insurance, vehicles. There's all sorts of different life insurance products out there. I'm not talking about term life. I'm not talking about final expense mortgage protection. None of this general life insurance stuff. There's higher level, I would say not higher level, more advanced, sophisticated products that offer cash value. It's permanent life insurance, meaning it doesn't expire. So you can actually build a cash value inside of the life insurance policy. And if you go and draw money out to go invest in real estate per se, well, it's considered a loan, which means it's tax-free. You're borrowing the money against yourself. You're borrowing the money against your future death benefit, actually, which is the money your family is going to get when you die. So using a whole life or an indexed universal life insurance policy in a sort of infinite banking strategy, which is a whole nother conversation, but it's an infinite banking strategy. And, I'd be more than happy to chat with anybody who would like more information on that. You can effectively dump money into a life insurance policy, borrow a percentage of it back out, tax-free, go invest in real estate, generate profit, pour the profit back into the policy while that money sitting in the policy is working for you, earning interest. So you can earn money in the life insurance policy and you can earn money in the real estate at the same time on the same bucket of money. So effectively having your dollar work for you twice as hard in two different asset classes. That's what an infinite banking structure allows you to do. So the tax-free is huge, but we all want our dollars to work twice as hard. If you can go make 10% in a real estate deal, but you can also make 8 to 10% in a life insurance policy at the same time on the same dollar, why would you not be interested in something like that? You're doubling the rate of growth by having the same dollar work for you in two different places at once. So, in a nutshell, there's a few different vehicles I would recommend. Very, very basic top level, a SIDRA, self-directed IRA. It's a tax-deferred account. Not my favorite, but it's better than using a bank account. Solo 401k, also tax-deferred. Not my favorite, but it's better than using a bank account. Roth IRA, if you qualify. Roth IRA typically is on a smaller scale because you're restricted as to how much you can contribute on an annual basis.
Right.
And then my favorite would be using insurance products as in an infinite banking type structure to go and borrow money against your death benefit, which is tax-free because it's considered a loan, and then going investing that in real estate. Tax-free is the best. And nothing's ever going to beat tax-free. And if you can get money tax-free, penalty-free, and fee-free, I would try to borrow as much as I possibly could, So that would be my suggestion for people that are looking to structure their real estate investments in a more tax efficient manner.
That's awesome. I think I'm gonna stop there because I don't want to keep making you dig deep, and I want people to reach out to you after this so that they can get their tailored plan from you. Absolutely. So I'll pivot here and say this. The name of the channel is Good, Bad, and Ugly. In your experience, I know with being a real estate investor and a tax strategist. I'm sure you've seen some good and bad things. Is there something that you would like to share that's a good story and maybe not a good story that maybe the audience can benefit from?
Yeah, absolutely. So you remember how I mentioned I had 13 Airbnbs at one point? Well,
Yeah.
let's just say that we had a couple of cases of vandalism, breaking and entering with the properties. Unfortunately, there was one story. I'll give the details on this one. So I owned an Airbnb in Orlando, Florida. I was actually visiting California at the time with my, at the time girlfriend, now wife. We were visiting her family out in California. So 3 hours behind Florida. I get a call at about 3 a.m. California time, Pacific time. And it's not a regular phone call, it's a FaceTime. And I'm like, okay, this is interesting.
Right.
So usually people, if it's a spam call, they won't FaceTime you. So I'm like, maybe it's something important. Maybe I should answer it. So I answer the call and it's this guy and he is cursing at me, screaming at me. Are you the owner of this property? I'm pissed off. I got a baby in the car, et cetera, blah, 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 right? Ripping me a new one because he got my number saying that I was the owner of the property somehow. Got through the property management layer and to me, 3 a.m., right? So he turns the phone around. He's on FaceTime, right? He turns the phone around. I'm like, I have no idea what you're talking about. I'm very confused. And he shows me the house, and there's about 80 people inside of my house throwing a party. They were partying until 6 a.m., literally.
Wow.
Throwing a party. The house is completely trashed from what I could see. And I'm just scratching my head like, how did this happen? Is this a prank? Is this am I unpunked? What's going on? Well,
Exactly.
come to find out, Jose, here's what happened. Someone booked an Airbnb reservation for my property. It was being used as an Airbnb, right? Someone booked the reservation, and typically about 24 hours out, the way I had it structured is it would provide a code to enter, like a passcode, because at that point, typically the people have made their final payment towards the Airbnb, and now they're all paid up, and so they'll be visiting the property and beginning their stay in 24 hours. So we gave them the code to enter the property. It was a smart lock, and in that, as soon as they got the code, and I found this out later on, as soon as they got the code, they canceled the reservation just in time, within seconds to spare, to get a full refund back on their card from the booking. Airbnb honored a full refund. Okay. So we took accountability because obviously we didn't have the structure right within Airbnb so that we could prevent something like this from happening. But they still decided to show up to the property after they canceled it because they had the code. And because I was in California and because my business partner was MIA, we had no idea. Someone else booked in the meantime to stay at the property.
Wow.
So the guy that called me was the guest who was actually supposed to stay there because he booked last minute and needed a place to stay. And my property was back online on the Airbnb website. So he entered the property. This party that wasn't supposed to be there that canceled and got a refund still showed up because they were doing, obviously maliciously. And essentially it turned to us having to call the cops. I'm over here and the cops say they can't do anything without someone representing the property being there. I have no one there. My business partner's in New Jersey. I'm in California. I don't know what. So I'm calling my parents. It's 6 a.m. right on a Friday. And I'm calling. So I called my girlfriend's dad. He lived an hour and a half away. He got in the car, drove to the property, met the cop there. And basically the cop told them they had 45 minutes to get out. And I said, why'd you give them 45 minutes?
Yeah.
And in that 45 minutes, Jose, they completely destroyed the property. It was so bad that we had to file an insurance claim. It took 4 months to get the property back up and fixed and back up to where it could be rented out again. It was a $55,000 insurance claim. So that was fun. So there was no rental income at all for 4 months. So that was a pretty big loss. We still had to pay the mortgage. $55,000 insurance claim later. We used all that money to obviously fix the property up. And after that, I decided to sell all my Airbnbs. That was such a bad experience for me. And it was just little things happening and all the other ones there, here and there, not that bad, that I was like, this is just not worth the headache. It's not worth the headache. I was up from 3 a.m. to about 8:30 a.m. Pacific time, 5.5 hours dealing with this issue. And I was like, if this is what it's going to be like, and again, this was a very extreme experience, I just don't want to have to deal with it. I'd rather make $100 a month on a long-term rental and not have to deal with any of these headaches than try and make a few $1,000s a month on Airbnb. Because honestly, that one bad tenant that wasn't even supposed to be there, they wiped out probably about 1.5 years worth of profit that we made. So we were back at square one. So that was a very, very terrible experience for me. That's a very ugly, bad side about real estate. It could happen, right? I know a lot of people have wonderful experiences with Airbnb and short-term rentals, Jose, but not I.
Right.
Not I. So I decided to get out of that niche. But on that same note, you asked for a good experience as well. So I have a tenant who they've been renting one property from me for almost 5 years at this point. They actually are a property appraiser. So they appraise properties for value and also rents in the area. So every single year, right before the lease renews, this tenant literally sends me a spreadsheet of all the comps in the area and says, hey, there's 10 comps in the area, right? And yours is rented at $2,500 a month. The average is rented at $2,650 a month right now in the area. Right out of the 10, the average is $2,650. Would you be okay if we increase the rent to $2,650 and just keep it at what the average is renting for? And I have a tenant that literally will increase the rent themselves because they're just trying to be fair. Because on that same note, if rents do go down, they would expect me to do the same for them. But they pay on time every month. I've never had a single issue from them. One time the AC went out and I had to call an AC guy to go over. That was it. Besides that, in 5 years, I've never had a single issue. Knock on wood. Rent has been on time, paid every month. Never. And this tenant basically goes out of their way to do research for me every year and figure out what a fair rental price is based on comps. So that's a beautiful experience, you know?
That's beautiful, all right, because I don't get that. And in fact, if I had a tenant like that, I probably wouldn't raise it at all unless taxes forced me to, just to cover my costs. But
right,
that's awesome.
Yeah. So
I wish they were all like that. That would be great.
I know. Tell me about it. So again, right, short-term rentals, I have a really bad taste in my mouth just based on my experience. Again, I know a lot of people have some really, really good experiences and they make a lot of money, and I tip my hat off to them. For me, unfortunately, it didn't play out like that. So I decided to pivot into the long-term rental market. My next move in real estate is to go into multifamily and, get involved in multifamily syndications and things like that, so that I'm able to have a larger piece a smaller piece of a larger project, because I think in terms of building true generational wealth and long-term wealth inside of a real estate portfolio, multifamily is definitely a pretty surefire way to get there.
But you're trying to go in as a LP, right? Not a GP?
Yes. Nope. I have no desire to be a GP. I just want to be silent in the background, collect my check.
Just for the audience, GP is basically another job. You get some of the profits of the running the assets or the multifamily unit, but it's a job. Where as an LP, you're investing your money, and you basically get, it's like what we call a mailbox check, right?
Yep.
You get your dividend every, hopefully, quarter, depending on what the agreement is for that particular that deal.
Absolutely.
So, well, all right. Well, Ian, if somebody wants to take advantage of your services and see what they can do about keeping more of their money so Uncle Sam doesn't take it from them, how would they get in touch with you?
Yeah, so there's a few different ways to get in touch with me. I'll actually share my cell phone number. Jose, I can share that with you, as well as my email. My email, cell phone, make sure everybody that's viewing it does have it. It'll hopefully be in some sort of description.
It'll be in the description below.
It'll be in the description. And then on Instagram, I am pretty active on there. I respond very quickly. My Instagram is simply my first name, last name, all lowercase, Ian Lottie. I'm the only one out there. So I have some content on there. I have some different educational pieces on there in terms of, again, keeping more money and lessen the pockets of the IRS. And so that's the best way to probably reach out to me, in addition to the email and phone. And I also have a calendar link that I'd be more than happy to have a conversation with anyone who's viewing this episode. I'm a wealth of knowledge, I feel like, in terms of tax strategy, financial strategy, et cetera. And so if you just want to pick my brain for 30 minutes, I'm very passionate about it, if you can't tell already. And I would love to have a conversation. And yeah, I'd love to provide value in any way I can. My biggest thing is education. And the way we educate is by providing resources, providing knowledge in specific areas. And so if anybody wants to have a conversation and maybe figure out how it might be applicable in their dynamic, then by all means, phone, email, I can text. Book an appointment on my calendar. I'll also leave that link with Jose, or reach out to me on Instagram.
Awesome. And just for those of you that may not like the YouTube platform, this episode will also be on Spotify. I'm trying to cross platform to make it easier for everybody. So if you're in the gym and want to sit there and just listen to what Ian's got to say and all the nuggets that he dropped on this episode, you can go over there and look at it for me. Ian, again, my friend, thank you so much for making the time. I know you're a busy guy and trying to multiply everybody's dollar, and I appreciate you doing that for them. And to the audience, see you on the next episode, fam.
Awesome. Thank you, Jose. See you, everybody.